Elisabeth, perhaps you could explain what macroprudential policy is and what its objectives are.
The objective of macroprudential policy is to make sure the system can lend in bad times as well as in good times. The financial system should never be part of the problem as it was in 2008, but really much more to be part of the solution. And that's why macroprudential policy making is so critically important. Let me give you a bit more background. Back in the global financial crisis, banks found it hard to lend to businesses because capital got constrained. And that's why, following the financial crisis, the Financial Policy Committee, or the FPC, was created to look across the system and really look at the so-called macroprudential part of the system. So look across the whole part of the system rather across individual firms. So pre-2008, most of the focus was on individual firms or the microprudential supervision, whereas after the financial crisis, the realization was that you needed another committee which would look across the system, so the FPC or Financial Policy Committee. So we really needed policy committees or a policy committee which would look much broader across the whole financial system. So therefore, the objective of the FPC is really look across all the risks across the system and to spot any potential risks, especially any systemic risks. It's a tall order because it's impossible to see anything which might be out there. And that's why it's so important to have people from different experience and with a different background to sit on the committee. And it's quite a new field. It's only this year that the FPC is celebrating its 10th birthday. So there's still a lot of research into the topic of macroprudential supervision. So I would sum this up by saying it's quite a new field. It's really important to get it right. And it's important to have the right tools to look at macroprudential supervision. At the same time, you really don't want to have macroprudential supervision, which would be supervision of the graveyard.
Perhaps you could tell us a bit more about the Financial Policy Committee. What's it achieved so far, and who sits on this committee?
So the FPC, or the Financial Policy Committee, is to some extent modeled on the MPC, or the Monetary Policy Committee, which is quite a bit older than the FPC. So the MPC sets interest rates, as everyone who listens to this will know, whereas the FPC looks across the financial system. The FPC are the macroprudential policymakers for the UK. Our primary objective is to identify systemic risks, so risk across the financial system, and to reduce or to remove them. To build resilience of the UK financial system, such as making sure that banks are adequately capitalized to weather any potential storms. And we've made great progress over the last 10 years to increase resilience of banks. We have dramatically increased the resilience of the banking system, so banks are much better capitalized now than they were during the financial crisis. Now, you wanted to know who's on the committee. So it's chaired by the Governor of the Bank of England. Deputy governors are members of the committee. And then there are 5 externals. I'm one of those 5 externals who bring experience from different walks of life. What's also important is have good coordination between different microprudential policymakers. So the CEO of the PRA, one of the deputy governors of the Bank of England, is a member of the Financial Policy Committee, as is the CEO of the FCA or the Financial Conduct Authority, to ensure there's really good kind of coordination both between macroprudential supervision and microprudential supervision.
Well, that's interesting. You mentioned the two other regulators who sit on the FPC. So I was wondering whether there was any tension between the job of the macroprudential regulator and the job of the microprudential regulator.
The macroprudential supervision is looking across the financial system as a whole, and the microprudential supervision looks at individual firms. So when we look across the financial system, obviously we want to make sure that the system is adequately financed, that there is a good capital base for the banks and major investment firms. We need both microprudential supervision and macroprudential policy to work closely together. And microprudential supervision really takes much more of a bottom-up approach, whereas macroprudential supervision takes a top-down approach. These different approaches may potentially lead to tension. For example, during a downturn, the objectives of microprudential supervisors and macroprudential policymakers may potentially come into conflict. As an example, in a downturn, as a rule of thumb, macroprudential policymakers tend to want institutions to act countercyclically. Banks would do this by releasing some of their excess capital and be able to lend to the real economy, versus microprudential policymakers who might want banks to build up their capital and therefore potentially lend less to the economy. And that's really why it's so important to have close coordination between both the macroprudential supervision and the microprudential supervision. As I mentioned earlier, that's why you have the committees overlap to some extent. So, as I mentioned, the Financial Policy Committee is chaired by the Governor of the Bank of England. All the deputy governors who are on the FPC are also on the PRC, the Prudential Regulation Committee. So that's one reason why there's very close coordination between the two committees. And it's proved especially helpful during COVID, because it was incredibly important to work closely hand in hand to ensure the response to the crisis was fast and effective, and so that banks would be able to lend to the real economy.
We've talked a bit as if it's natural that a committee makes macroprudential policy, but it's not necessarily the case that it has to be done by a committee. So what do you think are the advantages of policy making by a committee?
It's been really widely recognized in all walks of life how important it is now to have a committee which looks across the whole financial system. So decisions taken by the Financial Policy Committee are quite complex. So we cover a huge range of different topics. I mentioned capitalization of banks. Another area would be operational resilience, potential risks in the financial system, such as cybersecurity. We look across payments, to what extent new forms of payments could be a risk to the financial system. And that's why it's so important to have different members on the committee who have different experience and bring that experience when we debate these potential risks. And what's also important to know is that the FPC actually is a consensus committee. So it's not like the MPC who vote on, say, an interest rate decision. The FPC actually reaches decisions by consensus. Now, that's not to say that we wouldn't have disagreements or have a debate about different risks, but we debate them, we discuss them, and then when we come to a conclusion, we kind of reach a consensus by taking everybody's views into account. The other reason is that the FPC was really born out of the last financial crisis, and it was so clear that it was important to take all kinds of different parts of risks into account. So that's why it's really important to look at different risks across the financial system and then have a debate as to which risks might potentially be the biggest. So the bank now has 3 policy committees, as you'll know. So the MPC, the Monetary Policy Committee, the FPC, the Financial Policy Committee, which looks across the financial system, the Macroprudential Policy Committee, and then the PRC, the Prudential Regulation Committee, which looks at microprudential policy.
You've talked about the complexity of the decisions that you have to make on the FPC, and it's certainly true to say that the decisions are a lot more complex than the Monetary Policy Committee in the sense that you have many more tools at your disposal. Could you explain a bit about what those tools are?
Sure, and I'm glad you say that. We have wider powers and more tools, but I think that's absolutely true. And it's quite a complex set of tools, which actually aren't very well understood. So we have 2 different types of tools. So one would be the power of direction, where we can instruct the FCA, the Financial Conduct Authority, or the PRA, the Prudential Regulation Authority, to take specific actions. And we have wider powers of recommendation, where we can ask anyone to take action to reduce risks to financial stability. We were given these tools by the government when the Financial Policy Committee was first set up. And it's been widely recognized that it's important to look at those tools very carefully. So let me give you some examples of our existing tools. For banks, the most important macroprudential tools used globally is the so-called CCYB, or the counter-cyclical buffer, which is a power of direction. This is our main crisis management tool, when essentially we'll tell banks to either build capital in order to have more capital as available, or to release capital, especially during a crisis, and therefore have more capital available to lend to the real economy. Another example of a macroprudential policy tool is the mortgage market recommendation, which came into force back in 2014. And essentially, there are 2 different tools there. One is the so-called LTI, or loan to income ratio, where we would look at how big the loan can be somebody can be given versus the income they have, or the mortgage affordability test. So looking at to what extent somebody who takes out a loan is able to repay that loan.
Central banks often talk about the importance of transparency. Is transparency important for the Financial Policy Committee, and what role does transparency play for you?
Transparency is immensely important for the Financial Policy Committee. And it's definitely something which we need as a committee, mostly for 2 reasons. Firstly, transparency builds trust. So we obviously want to make sure that the public can trust us and trust the decisions we make. So it's really important that people understand and that we look at our different tools very carefully. The Latin word for trust is actually credit. As my colleague, the bank's current chief economist, Andy Haldane, once said, is a credit crunch is in essence a breakdown of trust. We saw this back in 2008 during the global financial crisis. Banks stopped lending because they didn't know how much capital they had, and they were afraid that there might be a squeeze on that capital. And nobody quite knew what the size of the risks that had built up in the financial system were. So that's why essentially there was a squeeze on capital. So the job of the FPC is to build trust in the financial system and to avoid that kind of crisis happening again. So therefore, it's absolutely vital that we share our assessment of the financial system, and also that we share that banks are able to lend to the real economy and that people will trust in that decision. Second, in terms of containing systemic risk, it's also important that we use our tools such as the CCYB, the countercyclical buffer, which I mentioned earlier, so that banks are able to release any capital back into the financial system. So recommendations are calibrated so that we can actually make sure that capital is released back into the financial system so GDP can grow. So if you think of the COVID crisis, that was also really important to make sure there was lending going into the economy. And those kind of decisions have real effect of people of the United Kingdom, and therefore the FPC must be accountable to the public. Finally, I'd just like to say there are different types of transparency. Clearly, we publish a financial stability report twice a year where we explain our decisions and we disclose publicly the decisions we take.
I'd like to drill down a little bit on the accountability question. You mentioned how important transparency is to accountability there, but I was wondering if you could explain some of the other things that you do in order to explain yourselves to the wider public.
There are many ways in which we're being held accountable. Probably the most important is through the Treasury Select Committee, or TSC, where politically elected politicians will hold us to account. So members of the Financial Policy Committee regularly appear in front of the Treasury Select Committee to explain their decisions. As I mentioned, we also publish our record or the Financial Stability Report to explain our decisions. And any appointments of external members of the Financial Policy Committee are subject to review by the Treasury Select Committee. And I can certainly tell you from my own experience, that's a very rigorous process. We also make sure we don't just sit in an ivory tower. And that's why it's so important to have external members on the Financial Policy Committee, because we bring experience from our executive career, from other things we do outside of the Bank of England to the decisions of the Financial Policy Committee. All of this ultimately speaks to how the Financial Policy Committee supports the people of the United Kingdom.
Thank you, Elisabeth. For more information on the topics covered in this interview, please take a look at the MSc in Global Central Banking and Financial Regulation. It's been developed and it's been delivered by the Bank of England and Warwick Business School. And we're very lucky to have Elisabeth Stheeman today, so thank you very much again for your time.
My pleasure.